this is a company looking at the books. There's a lot going on. You think, okay, this company's going public. They must be showing some pretty gaudy growth rates. Not necessarily the case. You kind of have to take a step back and remember, this business has been around for 19 years.
Right. So last year in 2017, revenue only grew about 5 or 6%, which I think was something around 220-ish million. But I think one thing that stands out to me is that while growth is slowing, their costs are rising even faster. So, for example, if you ignore some of these restructuring costs they had over the past 2 years, a lot of their operating expenses are kind of jumping. Like R&D was up 40% last year, sales marketing about flat, but general administrative was up 30%. So when you compare that against 6% revenue growth, obviously you're getting pinched on the bottom line, or in this case, they're posting net losses still. And it's like, what are you spending $50 million in R&D on when the platform is pretty, it's a survey. I mean, how complicated should it be? I mean, I don't know what they're spending the money on.
Yeah. And for a company that posts 70% gross margins, they post operating losses because their costs are currently outstripping their revenue growth. There was some slight revenue acceleration that we saw with this business. In the first half of 2018, they put up 14% year-over-year growth over the first half of 2017. That's still not very blistering, though. This company is losing money. It looks like it's going to continue to lose money for quite some time. And a big part of that is the fact that they have some pretty hefty interest payments as well.
Right. So that's another thing that's jumped out at me, too, is that this company is very deep in debt. So, for example, before the IPO, so at the end of the second quarter, they had about $40 million in cash on hand and then $320 million in net debt. Most of that would be in these credit facilities like a term loan as well as revolvers with some of these big banks who, interestingly, were also underwriters to the IPO. So after the IPO, they did say that they're going to put $100 million of the IPO proceeds towards paying down some of this debt. So after the IPO, now they have about $125 million or so in cash, and now $220 million in net debt. So that certainly improves their financial condition. But if that's the reason why they went public, that's not really inspiring to me as an investor. And I mean, I understand, like, if you want to swap out some of this debt capital for equity capital, you do save a lot of money because these interest payments and interest expense is huge. I mean, interest expense is like over 10% of revenue every quarter. And it just takes, they're already operating a loss. And then on top of that, having to pay out tens of millions of dollars of interest every quarter, it's just, it's a tough position to be in.